So, in this video, I have the honor to have a little interview with Gabe Bernarde, who is in Australia and most famously, basically from there and with his team at Viceroy, brought down a couple of companies and really shook up the markets. So it's really interesting to have you here. Thank you very much for this opportunity of the interview.
Thanks for having me. I'm looking forward to it.
Yeah, I mean, I heard you you studied accounting in Australia, and then directly, basically from uni, you got involved with short selling. Can you tell us a little bit about yourself? And I mean, how did you get involved with this?
There was a bit more. It was a bit more than that. So when I started uni, I started working full time and studying almost full time at a corporate restructuring firm and forensic accounting firm. I mostly dealt with, administrative support for liquidations, and then, got into sort of the running of a few administrations and businesses that went bankrupt. And obviously in that industry, you're going to come across fraud. And it really kind of struck out that the victims of a lot of these frauds were not overly financially literate or had been swindled in some way. And when we presented a lot of data to the regulators, they were very unwilling to do anything about it. So I guess there was this built up angst, and I kind of vented online, I suppose, about companies that I thought had, some structural flaws that could lead them to, collapse at some stage. And that's where, Viceroy sort of started. That wasn't the very start of Viceroy. I didn't off the bat write about Quintus or Syrah Resources, which were our first two reports. But, I got connected with a few hedge fund guys who saw some of my research. I did some, consulting work, basically like on the ground. So if people wanted to, test an investment thesis on an Australian company, they'd send me to go count people going in and out of the stores, speak to management, speak to customers, gather data to basically validate whether or not, here's my investment thesis. Can it be proven with empirical research? So it went from, corporate restructure to doing a bit more of this. And then I guess kind of fell into Viceroy because I met Fraser working on Quintus, and I was already working with Aiden, who's the third member of our team. And then it was just like, it just worked really well. We worked really well together, and it's just, I can't really turn back now. I mean, I'm pretty sure if I went back to being an accountant, no one's going to hire me. Mm-hmm. Pretty toxic. So yeah, no, I really enjoy it. So it just worked out for the best. I think everything fell into shape.
Happily unemployed, so to say.
Exactly.
Way. Okay. And I mean, basically, like back in the days, finance was a domain that was kind of like dominated in bank towers and specialists. Is it like now that the internet has really broadened the field for a lot of more people to participate and to dig deeper and uncover also frauds? And maybe in conjunction with that, you are in Australia, but a lot of the frauds you uncovered are in South Africa and even in Germany, where I'm at the moment. Mm-hmm. How do you do this across different geographies, languages, and so
on? I think so. I'll do the first part of the question first. I think the internet has opened up, especially from a research perspective, it's made it much easier for people to inform themselves on, finance generally, but also on stocks. The information is pretty, live. You always have data live, even when, a company doesn't really want you to have that data. So for example, like if someone was hacked, you pretty much find out the next day, right, on the news. But that data being available to everyone and being very accessible to everyone hasn't necessarily led to like good quality research. I mean, there is some, obviously like GameStop and AMC is that kind of scenario is, I think, representative of that. But this is something that, we really try to focus on. If you read our reports and you compare them to broker notes on the sell side, we really, really try to make everything that we write legible to someone coming on to finance generally with very fresh eyes. We're not there, discussing like valuations on intricate, bullshit forecasts for 5 years time for some penny stock. It's just not valuable. We try to base all of our research on, real data that we gather, things that are, tangible and actionable, and not make crazy, stupid forecasts. Mm-hmm. So I think from that perspective, yes, we want to make our research accessible, but we want to make it readable as well. And for the second question, we kind of screen, we're generalists. We don't really focus on like specific things. Like I'm an accountant by background. Aiden's an engineer. So we kind of self-teach a few things, but obviously like we get specialists on board if we're looking at things like mining companies or like, medicine, biotech, whatever. We outsource a lot of that, specialist opinions. But with it being cross geography, we just have a pretty rudimentary like screening tool, which we've updated ever since. That, it's like a big giant filter for every company that's out there. And we try to scope it down for red flags that we like to pick up on. So, companies that have no EBITDA to cash flow conversion, that have like meteoric, price hikes, companies that have directors or management that have been involved with previous frauds, don't have a big fraud. Sorry?
CFO changes.
CFO changes, auditor changes. And, there are tools that allow you to screen that deep. So I guess the ultimate goal is to find something that's too good to be true. And I think that we do a pretty good job of that. But also, this is it's almost like self-fulfilling, right? Because we've done a pretty good job of piggybacking whistleblowers and, bringing cases to the attention of regulators in the past. And for sure, like we get, some industry whistleblowers that will message us and say, hey, you should check this out. And then connect us, with their friends or their journalists that are very knowledgeable in those fields. So it definitely helps that we've built a reputation of being pretty hard ass on the research and not just kind of like writing a report and dropping it and walking away and taking a shot. So, yeah.
Well, I mean, you gave us a lot of how to identify a short list of candidate companies already now. Before we jump into that, I would like to ask you, what are your incentives? Do you get incentivized for kind of like the short report as a journalist, or do you get your own incentives by shorting a certain company through derivatives or directly through stocks or whatever it is?
I think that, I'm doing this for profit. I'm not, some holy crusader. But it definitely helps. Yeah, having worked in corporate restructure in the past and seeing that effect that fraud causes. The stakeholders are huge. It's not just shareholders who rarely get paid out in an event of a fraud, but also employees. You have government agencies, and it helps knowing that I can rip this Band-Aid off a festering wound faster than it can, hurt more people. So I don't really have a, ethical shorting problem that is pretty rampant in the press now. I think that it's probably a service that, short sellers like us and many others do such a good job of this deep dive stuff to uncover bad actors.
Yeah, I believe so. But in other words, I mean, you get your incentives through shorting these equities. I mean, I'm 100% on your side here. I believe.
Yeah, I mean that pays for the research, right? It's one hand kind of feeds the other, I suppose.
No, absolutely. I think at the moment, valuations across the board are sky high, especially in the US, but even in Europe and other markets. So I guess now is the time when there's more frauds than probably any time in the last 10 years. Would that be something that you also agree with? And how long would it take to at least wash out some of the frauds? Because if we just look at the specs that come to market in the US, I mean, for me, at least, it seems like a third of those are frauds and another third wildly overvalued. And if I look into German equities, there's a company like, for example, Northern Data, which I'm not sure if you had looked into it. It's basically having 8 to 10 employees. The CFO changes all the time, but the valuation is about $1 billion. So I mean, the list of potential frauds, or not necessarily frauds, but the list of extremely overvalued companies is sky high at the moment, right?
Yeah, I totally agree. And we thought, it's very difficult to say, because we thought it would be a great opportunity to short, sort of a few months ago, or even before, like pre-pandemic. We thought, hey, we're riding this huge bull market and everything's overvalued. But I think we learned pretty quickly that, I mean, from our perspective as well, like, doing activist kind of work, that it's not really worthwhile for us to short on a valuation only basis. I think it's just like it's the opposite of catching a falling knife, like if we have a problem with the business and the only problem is that it's wildly overvalued, we wouldn't really, that's not really our cup of tea. Like, this is not something that we want to short. It's something that's just going to blow us out of the water. We've seen it before with, others putting out short reports on companies just because they're serially overvalued. And we don't disagree. They are serially overvalued. There probably will be a correction. But I don't want to be the one to call that correction, because I'm going to be wrong and I'm going to, lose a lot of money.
Right.
But that being said, like, I think there is a lot of fraud out there. I think that the bull market, helps perpetuate this fraud. And I mean, even if we do have market corrections, maybe this wipes out a little bit. There's always this sort of, I don't know, all these old guys that, that talk to me, that have been in the game a long time, kind of say, like, this kind of blows out a lot of frauds out of the water and so on and so forth. But from another activist perspective, it was also, these companies that are frauds are lying to you in a bull market. They're not going to stop lying to you just because it's a bear market.
Sure.
So it's not necessarily easier to, or more profitable to pick out these frauds in a bear market. I think that, fraud is fraud, and it's going to be as hard as it's going to be to call them out. And we have successes in bull markets just fine.
No, absolutely. I mean, some stickers you moved by like $1 billion within a couple of weeks, and I mean, basically the market reaction based on the research that you brought out, and where the market read the research and said, well, I mean, there might be 10-20% that we don't agree with, and I didn't agree with everything in some of the research, but a lot of things were so clear that you couldn't basically disagree with. So so the market reaction, in my point of view, was quite reasonable. But on the other hand, and there we come to the next question of risk management. It seems like sometimes even there's fraud companies. There could be a shareholder like Archegos coming along and just taking advantage of a lot of short sellers. Even the investor knows, okay, there is a fraud case, but anyways, I will squeeze out the shorts. How do you manage that risk?
Don't get into, valuation shorts of 50% plus shorted businesses, I think is probably the best one. I mean, you have to kind of question how Melvin didn't see this GameStop blowing up as a possibility. Like, every man and his dog was short GameStop. It was just a horrendous covered situation. Right. And these guys played it perfectly, to be honest. Like, it is pretty much market manipulation if you went out and said, oh, hey guys, actually, let's coordinate this pump of GameStop because there's going to be a bunch of short sellers that have to be forced buyers. But I mean, they've opened themselves up to that. I don't know if what else they expected, really.
Right.
That's not really a situation that we want to get into. Like, we're not looking at super high short interest stocks that are really difficult to cover, that trade little volume, because that's the stuff that's really going to burn us. Someone once told me that the best way to get a really large short position in a stock is to start off with a really small short position and watch the stock go up. Okay. So I think that rings true, right? Yeah. This is not something that, so we actively avoid those situations, like really volatile stuff. Honestly, I think the most volatile stock that we've gotten involved in recently is Ricoh, which is our most recent publication. And this stock's gone up like 1,000% in the last year, but it's just such a, it's such a piece of crap.
Yeah.
And there's this rhetoric that there's, these cabal of short sellers actively there, like punching the stock, which is really just not true. I mean, I don't actually think that there's that much short in there at all, to be honest. Yeah. But again, it's just like extremely volatile things that can really burn you out. We had to be really sure with what we were writing on Ricoh to make sure that scenario didn't happen. Right. Because if there was sort of gaps in the company's presentation where they can still exploit this misinformation to shareholders, then it does create that scenario. But no, if that makes sense, we kind of avoid those, falling into a trap, I suppose.
Exactly. So basically identifying companies, if the company already has a very large short interest, you might not be interested in doing a lot of work because their base is already out. Yeah.
Not at all. We avoid that. We avoid that stuff. And cannabis stocks, cannabis stocks, especially, back in 2019, everyone was short cannabis stocks. It sort of, sure, like there were a lot of frauds there. But before these things collapsed, they went up like 2-3 times. Mm. So.
And what about stocks that had a lot of frauds and scandals exposed in the past? For example, in Germany, Deutsche Bank, in the last 2-3 years, it got a bit quiet, but before, basically every couple of months, there was something about money laundering here and there and manipulating the LIBOR and so on.
Yeah. I think that there's a lot of really, really intelligent people that can better analyze what's going on at something so intricate like a bank, that, for something like for us to come into it and think that we have an edge on information of what's really happening there is probably naive. Grenke's a bank, but this business model is pretty straightforward. Yeah. The business even is very easy to analyze. So we can have a pretty good idea of what's happening on the inside by observing what's happening on the outside. But I think Deutsche Bank is very much the opposite, where you're not really going to know something's wrong unless a regulator comes out and tells you. that, actually there's a problem here. So, again, we have people message us about, there's things like Zoom or, really ambitious shorts. And they may be totally right, like that this thing, is super, super dodgy looking and it might be fraud. But I think it's the same question as before. If there's too many eyes on this thing, it's not necessarily a good short for us. The borrow is typically going to be really expensive. There's going to be heaps of other names in there. As soon as the stock takes a dive, people might start buying, covering their shorts, thinking that's it. So for us, it's just not like a very good short play.
Okay, great. Now, talking about shorts, what I witnessed in the past is that a lot of short reports, and I'm not saying Viceroy short reports, but for example, in terms of DraftKings and other short reports, come out roughly a week or 10 days before a major option expiration day. Do you think that is a coincidence, or do you think that is not a coincidence?
I think you have to ask them. I don't know, to be honest. I don't know what the thinking is. I'm not in charge of the trading here at Viceroy.
Okay.
Like we try to obviously not coincide our release with something like, an annual report release date or an earnings release. We like to have that information before so we can be fully informed of what we're writing.
Sure.
We don't want to front run an estimate of an annual report with an estimate that we've made up and be totally wrong.
Yeah.
I think that's really the only thought that we give to it. And I wish I was as intelligent to write a report and put it 10 days out before the auction expiry. But you'll see that, like, most of the time for us, we're not sort of in and out of these things in 10 days. We will keep writing. Like, we're still writing about Grenke. It's been almost a year now. We intend to keep writing about it. We intend to keep writing about Rico. So immediately the price movements, great. If we get a big drop on the day, that's fantastic for us, but it's not, do or die.
Right. Okay. Also interesting that you are not the main trader, let's say, in your firm, but maybe mostly focus on the research side.
Yeah, I'm definitely research oriented. We're just like three really scrappy guys that can get into the weeds of things.
Right.
We're not really known for our trading prowess, let's say.
Okay. Yeah. Yeah, I mean, I had my share of losing by going short. Overall, it was very profitable so far, but I mean, there is a risk also. Even you are right, and I went short major indexes in 2008 before the crash, but somehow I didn't profit that much from it actually, because
Not too bad.
it rises more than you think. In terms of short sellers, two questions more for people maybe that get interested in becoming short sellers, in getting into this whole life. What do you think about the risks outside of financial risks, say regulators or even private investigators? And what about work-life balance? Because I think once you get a grab of something, like you see the CFO always changes and there's a lot of murky things popping up. I mean, can you say like, okay, now it's evening, I stop, or are you just going and go down the rabbit hole?
I think that's a really hard question. So I think let's start with risks. I think that the financial risk is obvious. We've discussed that. The second risk is retaliation. We're pretty sure of everything we write, and when we put it on a piece of paper and we have to publish this, we assume we're going to get sued. And it's happened before, and we assume we're going to get a BaFin letter, because that's the MO from BaFin, is to immediately start investigating us every time we write something in Germany. And we're happy, we're going to have to defend this. So you really have to acknowledge that you are going to come under immense scrutiny, potentially more so than whatever company you're writing about. And that's the major risk. We have there have been times in the past, especially with Wirecard, where, you know, PIs have followed us through town. They've set up cameras and, you know, in houses. They've wiretapped, like, you know, electronics in the house. You can find all that on the FT. Like, they were following me in Fraser around London for days. And that's really scary, you know, because then the PI start showing up at your parents' house. They start calling, you know, your girlfriend's uncles and stuff. And basically, you know, just intimidation tactics. They've tried hacking our website. If I go on my website right now, there's a brute force attack that has had 500,000 failed attempts within the last like 2 or 3 weeks. And I can see the data that they're plugging into it. And it's so intricate that I know that these guys have started looking into, like, stalking me essentially to get this data. So it's super scary. I don't think that you can't really remove your personal life from your work life and then just drop it and go home and think everything's going to be okay. Because sometimes you just bring it back with you. Yeah. So I think that's definitely, you know, I wouldn't recommend it to everyone. It's not a stress-free lifestyle.
Yeah. No, I think you have to be kind of like a daredevil to go into that.
Yeah, you know, and then like if we go back and I knew all these things when I started. I mean, when I started, I was like a train wreck, by the way. Like when we got exposed, because we started doing this anonymously at the start. Like when we got exposed, you know, and named by the press, like, that was absolutely terrifying. We got lawsuits the next day, PI straight in my house. Like people started calling our parents, everything, and it was just nightmarish. Whereas now, like, I've calmed down a little bit, but it's still kind of, knowing what I know now, then I don't know if I would have made the same choice. I don't regret it now, but I don't know if I would have taken a different angle.
Wow. Yeah. So that's a warning. I think it can be financially rewarding to be a short seller, to do short reports. Like it can be, I think, very interesting and fun, but well, it's kind of like a life decision. It's not just like an employment decision or something like that. It's a mission that you're on. Going back to the topic of identifying targets, you said a lot of things like if EBITDA doesn't really show up into cash flows, profits, and so on. You mentioned that you don't like to cover highly shorted stocks and so on. What about market capitalization? Is there something where you say, well, I mean, if it's under 100 million, it's just too small, and if it's above 100 billion, it's so large that is there a sweet spot somewhere?
I don't think it's a sweet spot. I don't think market cap is as important as the volume traded, and you know how large the float is. If you consider Grenke is, you know, it was probably right at some crossroad, because obviously it's, you know, largely held privately by the Grenke family. But there was enough volume that we could get a short position in there, and that there was a large enough volume that we could cover that position if it got, you know, completely unbearable.
Right.
But if this is, you know, generally speaking, the smaller market cap, and if we try to get, you know, below like $1 billion market cap, there's just not enough liquidity to actually build something meaningful, and, you know, make enough money that you justify doing it, knowing that you might get sued and having to pay legal bills.
Right.
So I think that's a big consideration. As far as how big, I don't think that's a big deal. It could probably be as big as it wants. I don't know how much impact it would have. And, you know, the information that we have would be any better than someone else. Because if it starts getting into these very large, like, intricate businesses, it's just very difficult to find something new, I suppose.
Right. Then when it comes to information gathering, what do you think, like whistleblowers, or can you tell us in like percentage terms, how much is, for example, going through the management board, checking out whistleblowers, checking customer accusations of frauds and so on? What do you focus on first when you have this long list of potential targets?
I don't know. It's kind of like a gut feel kind of thing. Like, with Grenke, it was pretty easy. Like, we were just shocked that we had what is essentially like a subprime lender lending to countries in Turkey and Brazil and whatever, or financing assets there with quasi deposit money from German banks or its own bank. And then the natural step is to then go out and check customer reviews, and then you start seeing like all this found the money laundering and all these shady deals with these third-party resellers of stock, and how they basically abuse the system to enrich themselves. But I think it's very like specific, a company specific. I don't think that there's one, and this is probably why this process can't be automated. There's no sort of one rule where, as soon as we shortlist this company, let's make more shortlists to then go out and find out why it's a fraud. I think it's just, you have to go beyond the first page of Google to then, start digging at specific numbers. Generally, if you don't understand something in the accounts, that's a good way to start.
Great.
Yeah, I don't know. So I'm sorry, I can't be more specific. It's just like,
sure. No, I think that
yeah, it's not,
you already you said a lot actually. What about media relations, and what role does media play in this whole thing?
So we have to be really careful as investors that we can't, for example, speak with people that have material non-public information. So that, we take very, very special care with whistleblowers, that when they send us things, we can't discuss topics with them where they have, or are still at the company or have only recently left. I think that the media, firstly, there are just incredible investigative journalists that, write a lot of these stories and dig into a lot of these holes that we just tack onto. And it's not because, we're better that we can go out and maybe find a bit more. It's because we're dedicating, 3 guys 24 hours a day to something and come out with whatever we find. But it's very important to have those media articles there to get informed of some of the bad stuff that these guys are doing already. And most of these journalists are so intelligent that you could, maybe even give them a call and start discussing topics with them. And then just share general data. They're quite receptive to discussing, what a company's doing wrong, like Recon Africa in Canada. We based out almost our entire research that we'd found was already found by a bunch of guys from National Geographic and from the Globe and Mail. We were just able to add to that and make a case that this is a bad trade.
Right.
But yeah, they can also then contact, I'm not a journalist, so I don't know, but I would presume that they can contact, whistleblowers, probably with less consequence than an investment professional.
Right. Yeah.
Very valuable resource.
Yeah.
I think, especially for us. Yeah.
Great. Well, before I leave you, is there anything I haven't mentioned, or anything that you would like to mention for my little audience? It might be just a couple of hundred people that watch this this video, but let's see. I hope it will work. But
I don't know. I think that I think the very best rudimentary advice that we have is, if something looks too good to be true, then it probably is. I think Twitter is a great resource. From a research perspective, you can go in there and find information that's pretty live. and you can speak to other investors that are following the stock, and get their opinions. And, you know, I'm super receptive. My DMs are always open if people want to talk to me about things. And I found that with a lot of other people on Twitter as well. So, you know, get yourself out there, talk to other people, be open to, you know, exploring criticism and, you know, debunking your own thesis to improve it. That's the best way, isn't it?
Perfect. Yeah. So, Gabe, thank you very much for this interview. And
no worries.
I mean, personally, I'm very looking forward for another short report on a German company where basically I have a look a little bit on different companies. So
yeah.
looking forward for that, because, or an American company, because I'm not that knowledgeable in South African companies, but definitely I will follow it. And it's always exciting to see the work, especially I think at this time when, I mean, there's hundreds or thousands of frauds and even more overvalued companies. It's really rare to find people that say like, okay, I will profit from it financially, but actually it's a life decision and it's hard work. And I really like that you go down that rabbit hole.
For sure.
And expose that.
And hey, maybe when we do another German report, we can tee up another podcast and we can discuss it.
Absolutely. Perfect.
All
Thank
right.
you so much, Gabe. And all the
Great.
best.
Thanks for having me. Cheers.